Welcome to the Financial Mentor YouTube channel. Here we will teach you how to become rich. So you've heard about ETFs and index funds. They both sound similar. They both help you build wealth. They both follow the market. But then someone asks, what's the difference? Well, that's what we're covering today. In this video, I'll explain the key differences between ETFs and index funds, how each one works, which one might be better for you depending on your goals. By the end, you'll know exactly where to put your money, confidently and without confusion. Let's jump in. First, let's make something clear. ETFs and index funds are more alike than different. Both are designed to track a market index like the S&P 500, which includes 500 of the biggest companies in the US. That means when you buy either one, you're not betting on one company. You're owning a tiny piece of hundreds of them, automatically diversified. Both are low-cost, passive, and great for long-term investors. They don't try to beat the market, they simply follow it. So in short, they both build wealth over time, they both benefit from compounding. They're both beginner-friendly, so why do we even have two types? Let's break it down. An ETF, or exchange-traded fund, works just like a stock. It's listed on the stock exchange, which means you can buy or sell it any time during the trading day, at market price. You can trade ETFs just like Apple or Tesla, instantly, through your brokerage app. That gives ETFs a big advantage in flexibility. You can buy fractional shares, set limit or stop orders, even trade intraday if you want to. Most ETFs are passive. They simply track an index, but there are also active ones that try to outperform. And because they trade on exchanges, their price can fluctuate slightly throughout the day, depending on demand. But overall, ETFs are known for their liquidity, transparency, and low costs. Perfect for modern, self-directed investors. Now, an index fund is technically a mutual fund that follows an index. The big difference? You can't trade it throughout the day. If you buy or sell an index fund, your trade only executes once per day, at the market's closing price. So if you place an order at 10 a.m., it will process later in the day, based on the closing value. Index funds are great for automatic investing. For example, setting up a fixed monthly amount from your paycheck. They're designed for long-term holders, not active traders. You also can't short sell them, margin trade them, or buy them instantly like ETFs. They're simpler, but a bit less flexible. Both ETFs and index funds are famous for being low cost, but sometimes ETFs can be slightly cheaper. Why? Because ETFs don't require active management or a middle layer of administration. Let's say, an S&P 500 index fund might charge a 0.08% annual fee. The equivalent ETF might charge a 0.03%. That sounds small, but over 30 years, even a 0.05% difference can mean thousands of dollars more staying in your pocket. So if you want absolute lowest cost possible, ETFs usually win by a tiny margin. Here's where ETFs really shine: tax efficiency. Because of how ETFs are structured, they can swap securities in kind, meaning they don't have to sell assets as often inside the fund. That keeps taxable events low. In contrast, traditional index funds might occasionally sell underlying stocks to balance the portfolio, which can trigger capital gains taxes for investors. So in most countries, ETFs are slightly more tax efficient, especially if you're in a place where capital gains are taxed heavily. In simple terms, less turnover shocks you less tax. Now let's talk about investor style. If you like simplicity, set it and forget it, an index fund might fit you best. You can automate monthly investments straight from your bank account. You never have to log in, check prices, or worry about market timing. But if you want flexibility, to invest manually, or even trade during the day, then ETFs are perfect. You can decide when to buy and at what price. They're also great for international investors who use modern brokerages like DeGiro, Interactive Brokers, or Revolut. ETFs are easier to buy instantly because they're on exchanges. Index funds, on the other hand, can only be purchased through the specific fund provider. like Vanguard or Fidelity. So ETFs are slightly more accessible, especially for small investors or beginners using mobile investing apps. So, which one's better? If you like automation, simplicity, and hands-off investing, go with index funds. If you prefer control, flexibility, and slightly lower fees, go with ETFs. At the end of the day, the differences are small. The real key is to start investing and stay invested. Because whether you choose ETFs or index funds, you're already doing better than 90% of people who never start. So now you know, ETFs and index funds are both amazing tools to build wealth. They're not competitors. They're teammates in your financial journey. If you found this video helpful, give it a like, subscribe, and turn on the bell. I'm your financial mentor, helping you make your money work for you.